Hey everyone, this is the continuation of bond evaluation topic. So today we are talking about yield to maturity, and here is the outline of this topic. So first we will be dealing with the basic understanding of yield to maturity. Then we have the calculation method of YTM, followed by some numerical examples, and these examples will help us to make decisions. So here we have some important steps related to bond valuation. So these steps, we normally name them. These steps are normally we can say, keep in mind the last lecture. So we were dealing with the pricing our bond valuation. So we already explained in detail. So at what price I will buy a bond, at what price the company will sell a bond. Then the second step is yield to maturity. What is yield to maturity? It's the average rate of return if the bond is purchased at today price, mean market price, and held till maturity. And this rate is different from the coupon rate. Coupon is a fixed rate and it will not change. And the yield to maturity, it's a rate of return at which the bond price is valuated, and this rate will remain same over its life. So duration already explained in last lecture. So it's the average life of bond. Then we have step 4, which is convexity, and it's the sensitivity of bond price due to change in the rate of return. So our topic is related to yield to maturity of today's lecture. We normally, as we know, average rate when bond is purchased at market price and held till maturity. And higher the rate, as we know, we have discussed in detail and we better know. So there is inverse relationship between present value and interest rate. If we increase the rate of return, then the price will be low. So higher the rate, lower will be price, our present value, and price is a present value, which is our future cash flows, which are discounted at appropriate rate of return. So formula of YTM and pricing are same if one component is given and we can find the other component. So in this case, we are going to find YTM, but we will be having the price means P naught means today our market price at which bond is purchased and held till maturity. So what will be rate? So we need to find the rate YTM. So here I will relate YTM with the cost of debt because bond is an instrument of debt financing. So once firm is going to issue the bond, so it means financing is raised by the debt, and bond is the long-term debt and it's tradable. So what will be the rate on the bond? So this rate we are going to find, and this rate is called yield rate or yield to maturity. The cost of debt is required rate on the company's debt. So company is going to issue the bond to raise capital to meet its long-term requirement or to meet its business requirement. So a firm needs funds, and one of the source of fundraising is external financing, and external financing through debt financing, tradable financing, which is bond. So we usually focus on the cost of long-term debt, which is bond, and the required return on the is the best estimated by the company's yield to maturity on the existing debt. So we may also use estimates of current rates based on the bond rating, and we expect when we issue new bond. And there is cost of debt is not the coupon rate. So cost of debt, it means that is the yield rate, which represents the rate of return on the bond, which is given by the company and received by the bond holder. So here cost of debt we are going to find by yield to maturity. So here is yield to maturity formula. So we have, as you know, we see two components. We discuss two components when we are talking about bond. One is coupon payment, the other one is face value. So the coupon payments are made at each time period. So at each time period, coupon one, coupon two, up to so on. So in this example, the coupon, for example, if the bond is having 5 years life, so we will be the investor will receive coupon for 5 times, and coupon payments will remain fixed over its life, and face value, that is price written on the bond, which will not be changed. It will also remain fixed. So in this case, so coupon payments are more than one equal payments, more than one equal payments. If there are more than one equal payments, we can say that we can use the annuity formula. Here we have the annuity formula. So this is C means coupon payments. One minus 1 divided by yield to maturity. So this YTM is a yield to maturity raised power time periods, and divided by I means that is YTM. So here we are talking about YTM, so rate of return. So that's why we are writing YTM plus face value divided by 1 plus YTM. So here we can individually solve. We can solve for the each time period coupon payments present value. We can find the present value of face value of bond. So, but if, for example, if the coupon is having 20 years life or 25, 30 years life, so you will be solving for 30 times. But once we have more than one equal payments, it's recommended go for the annuity. So annuity formula, so simple, you're not supposed to memorize this formula. You can take the present value interest factor of annuity from the table, time value of money table, which you already have access to the table. So this part is the present value interest factor of annuity, and this is the more than one payments, because here we are talking about coupon, which are more than one payments, and face value is only one payment. And here we can take the present value interest factor simple. So this is single face value is a single payment. Coupon are more than one payments. If coupon are more than one payments, then we will be taking we will be considering the annuity formula. So present value interest factor of annuity at given percentage for specific time periods, which are mentioned in the question. So here, face value is a single payment, so it will be made at the end of each time, at the end of life of bond. So both can be used. So here, before talking about yield to maturity, we need to understand the trading pattern of bond. So, bond can be traded either at discount, it can be traded at par, or it can be traded at premium. So what is discount? When market price means the price at which bond is traded is less than the face value which you will be receiving, which the investor will be receiving at the time of maturity. If today price is less than face value, so we name it bond is traded at discount. This is the very basic point for your understanding, for your understanding as well as for calculating of YTM. So this distinct differentiation between the discount, premium, and par will help you to identify the YTM. So trading at par, it means market price is equal to face value. So simple, when discount traded at discount, market price means today purchase price is less than face value. So what will be YTM? So always YTM should be greater than coupon rate, and we need to find YTM. It will give us the indication. So first we need to identify the trading pattern, trading behavior of bond, either it's discount, either it's par, either it's premium, then we'll be able to better understand. So YTM should be, say it may be equal to coupon rate. It may be greater than coupon rate, it may be less than coupon rate, but it's related with the trading pattern of bond. If it's traded at discount, then YTM should be greater than coupon rate. If it's traded at par, then YTM should be equal to coupon rate because market price and face value are equal, then YTM and coupon rate will be equal. If it's traded at premium, so it means market price is greater than face value. Market price is greater than face value. Then YTM should be less than coupon rate. So here, this point is very important. So before solving the calculating the YTM, we need to understand what is YTM. YTM is a rate which gives the value equal to market price. Means bonds selling price or purchasing price. So this is YTM is a rate which gives the value equal to market price. So our required value should be equal to market price. So we need to find a rate. What will be the rate which give us the answer equal to market price? So YTM can be found. The name of method is hit and trial method, or we can name it trial and error method. So we need to look at the name hit and trial. So it means we may have more than one attempts to find the YTM because name of method is trial and error method. So first of all, we need to make sure either bond is traded at discount or premium. So we need to differentiate. We need to make sure that bond is traded at discount or premium. So first find the present value. If after identifying the bond is traded at premium, so our discount, then what is mechanism? If bond is traded at premium, then no need to find the YTM because coupon rate will be equal to YTM. So we can simply write an assumption. If bond is traded at par, it means market price is equal to face value. So then YTM is equal to coupon rate. So if it's traded at discount or premium, so first step, find the present value, find the value of bond at coupon rate. So as we know coupon rate, once we are going to find the value at coupon rate, it will be equal to its market price. It will be equal to market price. So there is no need to find at coupon rate. The value will be equal to market price, means it's selling or purchasing price of the bond. So the market price will be at coupon rate. Whatever the coupon rate is, you're not supposed to find. Just for understanding. So first step is find the present value at coupon rate, then proceed accordingly. Always remember at coupon rate, the present value will be equal to its face value. I'm sorry, I made a mistake. So always at coupon rate, so it will be equal to face value of the bond. So face value of the bond, but we need to find the market price at coupon. So it coupon rate, if we find the present value at coupon rate, it will be equal to face value. If the bond is traded at discount, then the assumed rate should be greater than coupon rate. So we can relate here. If market price is less than face value, it means traded at discount, then YTM should be greater than coupon rate. So after making sure either bond is traded at discount or premium, then we need to find if the coupon is bond is traded at discount, then the rate should be assumed rate should be more than the coupon rate, and vice versa. If the bond is traded at premium, then the assumed rate, what is this assumed rate? We are going to find the YTM and the method is trial and error method. So we will assume a rate, find the value. Here is this is very important to distinguish either it's traded at discount or premium. So if it's traded at discount, so our assumed rate, suppose whatever the rate we are going to suppose should be more than coupon rate. If it's less than the if it's less than the market price is greater than the face value, it means traded at premium, then the YTM should be, assumed rate should be less than the coupon rate. So you need to be careful while understanding these 2 points. So here we can go for the next slide. So here we go. We have a question. What is question? Question is to illustrate or consider 1,000 face value bond with the following characteristics. So here current market price is 761, face value is 1,000, market price is being nowed is 761, its life is 12 years, coupon rate is 10% annually, it may be less than annual, so in this question it's annually. What we need to find? We need to find the discount rate that sets the present value of the bonds expected future cash flow streams equal to a bond current price. So what is YTM? The definition of YTM is the rate which gives the value equal to market price is the yield to maturity. So we are very clear in this question. So what is this question? Face value is greater than market price, or we can say market price, today price is, current price is less than face value, is traded at discount. So market price is less than face value, so bond is traded at discount, then YTM should be greater than 10%. So Y greater than coupon rate. So coupon rate, what is coupon rate? 10%. So now we are very sure YTM should be greater than 10%. It may be 12, it may be 15, it may be 14, and so on. It may be any value, but we need to be very careful. So what are the steps? So first we need to identify either the bond is traded at premium or discount. So we have identified the bond is traded at discount. So it means the YTM should be greater than coupon rate. What is the next step? Find the present value at coupon rate, which is always equal to face value. If we find the present value at coupon rate, which will be always equal to is face value. So face value is here 1,000. First step. So in first step, if we find the first step, that will be equal to 1,000. If we find the present value at coupon rate, that will be equal to 1,000. Then the next assumed rate, then the bond is traded at discount, then the assumed rate should be greater than coupon rate. So in this example, we can say the coupon rate should be it should be greater than 10%. So I normally recommend to students the difference between coupon and assumed rate may be, it's up to you. You can have any rate, but I recommend you can consider maybe 5%, but it depends how much is the difference between coupon rate and market price. So, but you can try at 5%. If I suppose the rate is 15%, why I am going to suppose? The name of method is trial and error method. Hit and trial method, trial and error method. So 10%, if at 10%, it will be 1,000. If it's 15%, so it's equal to 728.29. So it means YTM ranges from 10% to 15%. What we need? We need the rate which give us answer equal to 761. At 10%, we are getting 1,000. At YTM that we need will be equal to 761. At 15%, we get the value almost 729. 729 and 1,000. So 761 is in between 729 and 1,000. From next slide, we will make it more clear. If rate is 10%, what is this 10%? Coupon rate. At coupon rate, always value will be equal to face value. The answer will be equal to face value. At 10%, the value is 1000. We need YTM. What is YTM? It's the rate which gave us value equal to the market price. So market price in this case is 761. We need to find a rate which gives you the value equal to 761. So in this example, we need to find YTM, which is 761, and the assumed rate should be more than, because it was traded at discount, then the assumed rate should be more than 15%, more than coupon rate, and coupon rate is 10%. So we assumed 15%, which gave us value 728.97. So for this, we need to find YTM for these two is 10% and YTM, we name it X. The difference between 10% and 15%, the difference between 10% and 15% is 5%, means 0.05. And here, the difference between 1000 and 761 is 200. The difference between these two values is 239. The difference between 1000 and 728.96 is 271.02. We need to find X. X, this side, X divided by 0.05 is equal to this side, 239 divided by 271. So we need to find X. So here we are going to find X. X is equal to this 0.05 will be multiplied with 0.39 divided by 2.7108 divided by 2.7108. So X is equal to 0.04, or we can name it 4.41%. So what is formula of YTM? So YTM is equal to its I lower. What is I lower? This is lower rate of return. This is higher rate of return. So YTM is I lower plus X. So I lower means 15%, 10%. Which one is lower? 10% is lower. So means 0.10 plus X. X is 0.0441. So it's 14.41%. Solving for YTM by calculator yield. So 14.41%, which in case is very close to our approximate answer. So both answers are more or less same, 14.41 answer. There might be some nominal difference, that is the effect of rounding. So this was about YTM once bond is traded at discount. So here we can also find after two calculation, means this and the previous one is traded at finding the value at coupon that will be equal to face value. We can also write I lower, which is 10%. I high, what we assumed is 15%. So this is 15%. Multiply by present value at lower, means 10% present value was 1000. If present value at YTM, so it means the rate we need, what will be the value here? That is 761. So present value at lower is, means 10% is lower, 15% is higher. 10% it's 1000 and 15% it's 728.96. So after simplifying, so first we solve this part. So after that we solve this part, 0.10 plus, so this is the 0.411. So 14.41% is the yield to maturity for this example. Here we already discussed this example in the class. So market price is 1600 and its face value is 2000. So life is 12 years and its coupon is 12%, and we need to find YTM. Already we are done, and we had example in the class. So now we have another example. So face value is 1000. Bond is traded at face value 1000, and today market price is 1200. It means its buying price is 1200. So market price is greater than the face value. If it's greater than face value, we can say that is traded at premium. Its life is 12 years and coupon rate is 4%. We need to find YTM. So note what is note, market price is greater than face value. So bond is traded at premium. Then YTM should be less than coupon rate. So our answer should be less than 4%. So we can find with the example. So first step is find the rate, find the value at coupon rate. What is coupon rate? 4%. So if 4%, our answer should be equal to 1000 because at coupon rate, value should be, present value should be equal to face value. It will give us the answer. If we find by using this data, it will give us the answer 1000. At coupon rate, our value should be equal to face value. So no need to find. In last example, I didn't find. So here you can check by yourself, and here you can have the value which is for 4%. So for 4%, so here is the formula C. First, we need to find the coupon. It's the 4% of 1000, 4% of 1000, which is equal to 40, which is equal to 40. So here, 40 is the C into 1 minus 1 divided by YTM. What YTM we assume? That is the coupon rate 4%. Number of shares are 12. So divided by YTM 0.40 into face value, which is 1000 divided by 1 plus YTM. So after simplifying, we are getting the answer that is 1000. So no need to find, just this is for your understanding. So if you understand it, so it's okay. So we are very clear. So bond is traded at premium. Once it's traded at premium, so we can find that the YTM should be less than coupon rate. Coupon rate is 4%, and here we can take 2%. For example, assumed rate. The next assumed rate should be less than the coupon rate. So the next assumed rate, what we are taking, that is 2%. So at 2%, coupon payments will be same. Here we can just write, instead of 4%, we can write 2%. The number of time periods are same. So 0.20. After simplifying, we are getting value which is 1211.51. So it ranges from 2% to 4% because we need to find YTM. So what is YTM? The rate. What is YTM? The rate which give us value equal to 1200. So at 4%, value is 1000. At 2% is 1211. At 2%, it's 1211. So it means 1200 is in between these two rates. So YTM ranges from 2% to 4%. So from this slide, remember, I lower should be always at the top. So 4% and 2%, which one is lower? 2% is lower. So 2%, the value is 1211.5. Here normally students make mistake. So they write YTM before, sorry, the coupon before. No, lower rates you need to keep first. So at the top, at the lower, in front of lower, we have the present value at lower. So we need to find YTM. So what is YTM? That is the rate which give us the market price. So it's 1200 at 4%. That is the because it's premium. So it means our YTM should be less than coupon rate. So here at coupon rate it's 1000. So difference between YTM and 0.2 we denoted X. So 2% and 4%, the difference is 2%. Here the difference between 1200, 11.5, 11.51 and 1200 is 11.50. So So the difference between 1100 and 1.51 and 1000 is 211.51. So x divided by 0.02. Okay, so here is 11.5 divided by 211.51. After simplifying, the value of x is 0.011. So YTM is equal to I lower. What is I lower? 0.2 means 2% plus x is 0.001. So it's giving us the exact answer 2.11%. So solving for YTM, 2.11% is the exact rate which will give the answer equal to 1200, means market price of the bond. So this is the concept related to if bond is traded at premium, bond is traded at discount. So here we can also find I lower, that is 2%, I high, 4% minus I lower, 2%, 2%, 4% minus 2. Present value lower means 2%, it is 1211.50. Present value at YTM is the market price. So it's 1200 divided by present value at lower is 1211.51 minus 1000. So it's giving us, after simplifying, 2.1%. Later we have another example. It's related to, already we discussed in the class, it's related to, suppose we have bond currently outstanding, life is 25 years and coupon payments are 9%. Coupon payments are 9%, but these payments are made semi-annually, and the market price selling the bond currently selling at discount. Market price is 908.72 and its face value is 1000. So it means bond is traded at discount. So we need to find YTM. Market price is less than face value. So bond is traded at discount. Then YTM should be greater than 9%. So here the concept, what we need to understand is this is the less than annual payment. Semi-annual means they are the twice in a year. Twice in a year. So we need to find the rate in twice in a year. So we can simplify here. First we have to half of 9%. This YTM will be going to be divided by 2. Half of this is 4.5. And how many semi-annuals in 25 years? So 25 multiplied by 2, it means 50 semi-annuals. So we need to, once we have compounding, once we have frequency of payment less than annual, so we multiply with the frequency, the time will be multiplied and the rate will be divided. So the rate means coupon rate is divided by 2 if it's quarterly, divided by 4. If it's quarterly, 25 multiplied by 4. So here means life will be multiplied, the time will be multiplied with the frequency and the rate will be divided by the frequency. It's semi-annual means 2 times, twice in a year. So this will be divided, means coupon will be divided by 2. So it will be 4.5. So obviously number of semi-annuals in 25 will be 50. So after that, so coupon semi-coupon rate is semi-annual coupon is 4.5. So its face value is 1000. So we need to find the coupon payment. So semi-annual coupon payment is 4.5. So obviously coupon payment will be 45. 4.5% of 1000 is equal to 45. So here we go. So the same formula, first of all, first we need to find at coupon payment. What is semi-annual coupon? 4.5%. So always at coupon rate, the present value should be equal to face value at 4.5%. So we will be getting 1000. Just for your understanding, no need to calculate. So at 4, we can simply write at 4.5% is the semi-annual coupon rate. Then the value will be equal to 1000. So we also prove here just for your understanding. So the same formula, coupon payments for 4.5%. Why 4.5%, 45? If it's annual, then it should be 9 multiplied by face value, 9%. So it should be double of this because it's the semi-annual. So that's why we are choosing the semi-annual coupon payments. So semi-annual, one semi-annual is 45, and how many? It's going to 50 semi-annuals in 25 years. So after simplifying, its answer is equal to, or p value is equal to 1000. So as we discussed, we know that the bond is traded at discount. If it's traded at discount, so obviously the YTM should be more than the coupon rate. So semi-annual coupon rate is 45%. So obviously the assumed rate, next assumed rate should be more than 4.5%. We took sample, for example, we took 9%. So we can find at 9%. At 9%, it's giving us the price means value 506, almost 507. So what we need 908. So what we have at 4.5%, we have 1000. At 9%, we have 506. So it means 908 is between 506 and 1000. So we can simplify in the same way. So at lower rate, 0.45, what we find? 1000. YTM, we need 908, means the rate which give us the value equal to market price. At upper rate means higher rate, so I high, that is 0.09. So here we go, that is 506.72. So here we need to find YTM, which we denote by X. So the difference between these two rates is 0.04, means 4.5%. The difference between 1000 and 908.7 is 21.28, and the difference between 1000 and 506 is 493.28. After simplifying, we are getting the value of X. This is equal to 0.083. How we find YTM? I lower is 4.5% plus X, which is 0.045. Sorry, 0.0083. After simplifying, 5.3% is annual coupon, annual YTM. Sorry, semi-annual YTM. So semi-annual YTM is 5.33. What will be annual? 5.33 multiplied by 2, 10.66 will be the annual YTM. So other way, I lower 4.5% plus I high, that is 9%, minus I lower 4.5%. Present value at lower is, this is present value at lower, it's 1000. Present value at YTM is, this is 908.72 divided with present value at lower 1000, and present value at high is 506. So after simplifying, the same answer. So the semi-annual YTM is 5.33%, and if we need to find annual, it will be equal to 10.66%. 10.66%. So this is question we already discussed in the class, and here is all about the discussion of YTM or cost of debt YTM we can. Thank you so much. So see you in next class. Thank you.